He kōna ipurangi tēnei nā te reo irirangi o Aotearoa.
Who actually needs to charge GST? And what if we could take it off some of the essential things households have to spend money on? That's some of what we're chatting about on this week's episode of No Stupid Questions, alongside a question about going overseas with a student loan and why we don't have a $500 banknote, which I thought was a good point. I'm Susan Edmunds, I'm RNZ's money correspondent. I'm joined by Justin Gregory, who has your questions.
I do, and I've never seen a $500 banknote, obviously, but not just for the reasons that we're going to go into.
Yeah, sorry about that. Yeah. Okay, let's get into the tax one first up.
Our first one is from Robert. He says, why is it that if you're not registered with NZBN, that's the New Zealand business number, then you don't have to pay GST? But if you are, you're responsible for collecting it and a garage sale doesn't qualify. Is there a dollar amount involved?
Okay, so there's a bit to unpack here.
Just a little.
A bit. First, whether you have an NZBN or not doesn't actually matter at all when it comes to GST. Those are totally different things. You don't even need a company to potentially need to register for GST. What matters for GST is whether your business or sole trader revenue is more than $60,000 a year. And that's revenue, not profit. So if you're making sales of more than $60,000, you need to register for GST. Below that, you can register, but it's optional.
Optional, okay, but why would people register for GST, if they don't have to?
Well, generally because then they can claim the GST that they pay on their costs. So when you're registered for GST, you add GST to your prices, then you send that money on to the government, but you claim back the GST you paid on your business costs too. So if you're not at that level of income, 60,000, but you have a lot of costs, it could make sense to register for GST.
Okay, that does make sense. And there's been quite a bit of talk about this, hasn't there, that threshold, that $60,000.
Yes, that's right. So Labor says if it's in government, it would push up the threshold to $80,000. It actually hasn't been adjusted since 2009, so it probably does make sense to look at it at some point. We hear about businesses who are holding off doing more sales and things like that because they don't want to trigger the threshold, which that seems quite intense to me. But I spoke to Alan Bullough, who's basically a GST guru at Deloitte, and he says that would probably just shift the problem if we increase the threshold rather than really solve it. And he says actually there's an argument that maybe everyone should be captured for GST now, because it used to be that it was much harder to comply with the rules, but now it's so easy to track because everyone's doing their cloud accounting and all that sort of thing.
All right, but what about the garage sale point of sale?
Yes, that's right, the garage sales. So selling private assets doesn't incur GST. But just to complicate things, Alan also tells me that while the normal thing is that most people holding a garage sale won't have GST obligations, he says based on some Inland Revenue comments in the recent GST discussion document, there are some people within Inland Revenue who could form the view that if the person was registered as a sole trader in another activity and then was having garage sales somewhat regularly, then the garage sale could be part of their overall taxable activity. So that's confusing, but in general, most people wouldn't have to worry about GST with a garage sale.
We also have a question here about GST. This is from Keys, who says, with the state owning 51% of power companies, why aren't the politicians talking about taking GST off your power bill?
Yeah, last election we were all talking about Labor's plan to take GST off fresh fruit and vegetables, I think, but I haven't heard anyone raise the idea of power. I think the same problems would apply here, though, that we talked about at that point. The big criticism of any plan to take GST off anything is that it makes the system way more complicated. So at the moment we have a really simple GST system. It's just on pretty much everything. So we don't get into debates about which food is a luxury and which isn't, which has led to some pretty strange situations overseas. In the UK, there was a huge battle about whether a Jaffa cake was a cake or a biscuit, because if it was a cake there was no value added tax, but if it was a chocolate covered biscuit it would have tax of 20%. So Jaffa cakes were ultimately ruled not to be a biscuit, but that is a waste of time and resource. And no one's going to debate whether there are different types of power, obviously, but the concern is that if we exempt it then it adds more complication, potentially more expense. And people also argued that there's no guarantee that taking GST off food would actually mean prices were lower, because theoretically, and maybe we're being cynical, but shops know what we're willing to pay for these things, so they might just put the price up to that level. And Consumer New Zealand's Chief Executive John Duffy tells me he has the same concern about power. And I guess anytime we take a tax off something, it's probably going to go on something else.
Good question here from Rob. He says, we decimalised our currency in July 1967. Based on the Reserve Bank inflation calculator, $100 in the second quarter of 2026 was the equivalent in value of, good Lord, $4.19 in July 1967. Crikey. We've lost a bit of small change in that nearly 6 years and gained the $50 note. This is all Rob. But the $100 note is still the largest denomination we have. Only 84 cents in 1967, says Rob, would buy us what $20 buys today. And yet they're pretty much the standard denomination that we use day to day. Rob says, I get that we use cash less than ever, but it seems kind of weird that we haven't added even a $200 note, let alone a $500 or a $1,000 note.
I thought this was such an interesting question, so I asked the Reserve Bank for help. And they say it's their job to make sure that cash meets our needs. The Reserve Bank does research and analysis, including surveys, to understand what the needs are and how they might be changing. It says so far it hasn't seen any evidence that a larger note is needed. It says $20 and $50 notes are the most in demand, and people are less keen for $5, $10 and $100 notes. It says Series 7 notes were first issued about 10 years ago, so those are the most recent ones we've got. And during that process, there was no evidence that a larger note was needed. The bank says it's not yet thinking about a Series 8, but when it gets there, it'll be thinking about things like the denomination mix, whether we might need larger notes, and also which things might be better as a note and which might be better as a coin, and also, the appearance of the currency and things like security features. And it will do that by talking to a range of stakeholders representing different interests, it says.
Now, Elliot's after some advice. Elliot says he's in his second year studying engineering. Good on you, Elliot. He's been borrowing the maximum living costs loan, yep, for sure, as well as for course fees, and his loan is currently $47,000. He's not worried about it or paying it back. Okay. He thinks he'll get a great engineering job, plus the opportunity to change the world for the better. Well, good on you, Elliot.
Yay!
Yeah. but, says Elliot, his question is, given he expects to graduate with about $80,000 in debt, what does that mean for his financial outlook if he finds a well-paying job overseas that'll pay him double what he earns here? Elliot says, how can I manage that future investment into myself while balancing the taxes and repayments that I'll have to pay overseas on that grand total if I move to the UK, Europe or similar? So Elliot's question really is, would it be wiser to stay in New Zealand for now, pay off some or all of that loan locally at 0% interest, then head away overseas loan-free? Or, pending I get a very well-paying job, asks Elliot, would it not matter?
Yeah, so just quickly, as Elliot says, when you're in New Zealand and paying back a student loan, it is interest-free, but it starts accruing interest when you spend more than 6 months overseas. IRD requires a minimum payment twice a year from people who are offshore, which at the moment is $2,500 a year for someone with a loan of that amount. Inland Revenue warns that if your loan is more than $89,285, very specific, the repayments won't cover the interest at the moment. I talked to Nick Brunston, who's a principal economist at Infometrics, about this. Nick, what should Elliot be thinking about?
For some of these issues specifically, you really do want to figure out what sort of your earning potential is in New Zealand and what it is overseas, and weigh that up with what it's going to cost to live overseas, because it's not all a one-way bet. You often, might get paid double in London, but you're going to be spending an awful lot more on your rent than you would in Christchurch. So that's kind of your key baseline. They're really trying to trade off, am I going to get paid enough overseas to make it worthwhile to be paying interest on my loan, or am I better to accept a lower rate of pay in New Zealand and enjoy an interest-free loan? I don't know exactly what they're going to earn as an engineer, but the average earnings in New Zealand across absolutely everyone, engineer or not, was about $82,000 last year, which tells us how long it would take them to pay off their loan. So if you walk out of uni, you've got an $80,000 loan, and you walk into an $82,000 job and you earn that for the rest of your career. Just paying the bare minimum in New Zealand, no interest. It takes you about 12 years to pay off your loan, just with IRD, just taking the bare minimum off your paycheck each fortnight. So I thought, okay, 12 years of paying off your $80,000 loan is kind of the benchmark. If you go overseas, you've got to pay, with an $80,000 loan, you're going to have to pay IRD at least $5,000 a year. That's sort of their minimum repayment for that kind of level of loan. At that level, you're sort of barely clearing the interest because the interest is racking up at over 5% at the moment. However, if you went from paying $5,000 a year to $9,000 a year when you're overseas, that would get your loan paid back in the same amount of time as it would in New Zealand. You'd be paying a little bit more because you're trying to keep up with that interest, but you could still knock it out in 12 years. So if you kind of compare the two, essentially all you need to do is earn about $2,000 more per year after tax overseas to make it worthwhile going overseas.
Of course, lots of individual factors go into it, but at least that's a start.
Best of luck to you, Elliot. Go well. Right, that brings us to our fun fact of the week. This is a fun fact, or is this just a really weird fact? Go on, Susan, what is it?
Well, it's about cheese, which is one of my favourite things. Yes, everything's better with cheese. Did you know in Italy, banks issue loans holding cheese as security?
You'd be
So
shocked
in
to
New
know I
Zealand, we
didn't
usually put
know
our...
that. No, I didn't.
You haven't had a cheese loan lately?
No.
In New Zealand, we usually put up our houses or whatever as security, but in Italy, some banks will take cheese. And that's because some types of cheese take a few years to age, and so the banks can basically provide some cash to producers before they get to the time where they can sell it. But climate change is becoming a threat, so extreme heat is threatening the cheese banks.
The cheese
Their power
banks.
bills are up.
Extreme
Yeah, that's
heat.
right, the cheese banks.
The cheese banks. Whoa.
Yeah, their power bills are up 30%. So that's tough going with the heat wave. And cows eat less when they're hot, apparently, which means their milk yields are down. And apparently, Italy produces 4 billion euros worth of cheese a year. So this does have the potential to be quite a big cheesy problem.
And I'm at a loss for words about the cheese banks and the enormous problem that climate change is causing for Italy's cheese banks and their 4 billion euros worth of cheese a year. So if you have any other questions about anything to do with money, please send them to questions@rnz.co.nz. Who can top the fun fact about the cheese banks in Italy? Go for it, folks.
No Stupid Questions with Susan Edmunds was written and presented by Susan Edmunds. That's me. Justin Gregory is the producer. The engineer is Mark Chesterman. Thanks to Robert, Keys, Rob and Elliot for their questions, and Alan Billow, John Duffy, the Reserve Bank, and Nick Brunston for their answers. Follow and listen to No Stupid Questions with Susan Edmunds on Apple Podcasts, Spotify or any podcast app so you don't miss an episode. Stay safe, everyone.